Have you heard about the fee changes the government is making that may be causing people with higher credit scores to pay more to help people with lower credit scores? In this video, we're going to dive in to find out if this is really true and break down what it really means for you when you're buying a home. Hey everyone, so you've heard of the LLPA, loan level price adjustment, in the news, and you're thinking to yourself, you will now be paying higher lending fees if you have good credit than those with a lower credit score, and you're wondering how on earth is that even possible. In this video, we're going to break it down for you and what this means if you're thinking about buying a home. And just really quick, my name is Xochitl Cervantes with RockStone Real Estate Group here in Austin, Texas. And if you're looking to make a move, well, let's chat. So the story here is that Fannie Mae and Freddie Mac changed the fees they charge on loans that on the surface appear to make people with higher credit scores pay more in fees to offset costs for people with lower credit scores. Basically, the perception is people with higher credit scores and higher down payments are getting penalized in order to help people with lower credit scores and lower down payments buy homes. This has led people to think that if you have a lower credit score, you'll pay less in overall fees. And there were even people suggesting you should purposely damage and lower your credit score to pay less in fees. Let's just say up front, don't do that because that's just not true. And damaging your credit score will cost you. This policy change has caused a lot of confusion since conflicting messages have been presented by different groups for the reason behind these moves. First, we've got Fannie Mae and Freddie Mac stating categorically the reason for the changes is not at all to encourage purchases of homes by lower credit score borrowers or to penalize higher credit score borrowers. But then we got industry groups like the National Association of Realtors coming out saying that this is the reason and they're encouraging the government to scrap these fee increases. Let me try to help clear up the confusion for you. First, who exactly is Fannie Mae and Freddie Mac and why are they charging these fees on the loans? Well, no, they're not your great aunt or your great uncle you've never heard of. They are the government-run corporations responsible for insuring the majority of mortgages made in America. By insuring, it means they step in to help pay back the companies actually lending the money for home purchases. If the home buyer defaults on a loan, they have to maintain a certain amount of money in their accounts to maintain what's called liquidity, to make sure that if people do default, they have the funds to pay out the money. In order to maintain those cash reserves, they charge certain fees on home loans. So why did they actually make the change? Well, essentially in 2008, after the last market crash housing crisis, Fannie Mae and Freddie Mac were taken into conservatorship and they called this combined entity the enterprises. They have to charge fees on loans in order to provide a form of insurance to ensure that taxpayers that now own Fannie Mae and Freddie Mac in case of default of these higher risk borrowers. Over the past couple of years, Fannie Mae and Freddie Mac did a huge risk assessment and realized the existing fee structure didn't accurately reflect the risk profile for each borrower. And so basically what they're saying that the fee structure that they had implemented after the 2008 crisis was simply outdated and it wasn't actually working quite well enough to maintain the needed liquidity in the system. They had to restructure the fees according to each individual class of borrowers, risk based on credit score, down payment, debt to income ratio, and income levels in order to provide liquidity to Fannie Mae and Freddie Mac to make sure that the taxpayers don't end up on the hook again for another potential crash. They have been undergoing an overhaul to adjust fees and have been making this adjustment for different loan types over the past 2 years. For loans for second homes, high balance loans, or cash out refinances. This was the final stage of the risk rebalancing. On the surface, it does appear that they are passing the risk of the lower credit borrowers onto the higher credit borrowers, but it appears that they may have been an unintended consequence of the risk rebalancing. It appears simply that overall the higher credit score borrowers simply weren't being charged enough in the first place in accordance with the risk profile. So they had to rebalance risk to maintain overall stability and liquidity of the system to help prevent a catastrophe like what happened in the 2008 housing crisis. So here's the gist of this. you're still going to be far better off to put at least 20% down payment and have a higher credit score. When you look at the table here, overall your fees are going to be much lower if you have a higher credit score and 20% down payment than if you have a lower credit score and lower down payment. By putting 20% down, you'll avoid having to pay mortgage insurance, which is typically going to be hundreds of dollars per month to your mortgage payment. It's going to add them. So whatever you do, please don't damage your credit score to avoid paying fees. And are you paying a higher fee if you have a higher credit score? Well, maybe, but it depends on where you fall on the fee schedule. You may actually be paying less. So here's what you need to do if you're looking at buying a home. Reach out to me and I'll put you in touch with a great lender I work with here in Austin who will help you get a great rate on your loan no matter what your situation is. And if you like this video, you have any comments, please leave a comment on the video. Please subscribe to my channel. Let me know what you think of it. Let me know if I can assist you in any way. And I'll see you on the next video.